let me start, Sergio, by thanking you for the introduction and making this possible. My Portuguese is not good enough to guarantee that I followed everything, but yes, we've been working for a while to make this happen, and I'm very grateful to the Foundation for accommodating my schedule and assembling an impressive audience. What I would like to do this afternoon is as soon as I figure out how to operate this pointer.
Closer to the mic.
Closer to the mic.
Não é mais fácil fazer simplesmente no page down and page up? Let's do it the conventional way.
We'll do it the old-fashioned way,
Works better.
as they say. So the motivation for my talk this afternoon is what I think is widespread discomfort with the operation of our global monetary and financial system and the role of central banks in its functioning. Theme of the Republican primary campaign in the United States, and certainly of electoral year politics in the US, has been worries about our fiat money regime, monetary regime, as a potential engine of price and financial instability. There are worries about our system of dirty floating exchange rates and how it gives rise to imbalances and volatility. There are worries about whether there will continue to be an adequate supply of international liquidity in a multipolar world, but what is still a dollar-based international monetary and financial system. And there are worries that you will well know in Brazil about the cross-border spillovers created by national monetary policies, about the impact on countries like Brazil of quantitative easing in the United States and so forth. So what I want to do in this presentation is to use the long sweep of history to provide some context for these worries and perspective on the future. The history will come mainly at the beginning and at the end, and the meat of the sandwich between the two slices of historical bread will be some commentary on the current situation as it affects currencies and monetary policies in the US, in Euroland, and in China. And I think this afternoon I will probably talk disproportionately about Europe, because once again today there have been some rather distressing events on European financial markets and some perplexing statements by European policymakers. So how have monetary systems evolved in the long run? When I think about the long run, I go back 150 years or so, and I distinguish four phases or regimes. There was the long Victorian era, or more precisely, the long Victorian and post-Victorian era, stretching from the 1870s or so up to the early 1930s. That was the period of the gold standard, of course. It was the period when many modern central banks first came into existence, and when central banks basically adhered to rules for gold convertibility and for exchange rate stability, and that was the basis on which they formulated monetary policy. They had to keep the domestic currency stable against gold. They had to keep their exchange rate stable against the pound sterling, and that was it to a first approximation. The reality, of course, was that wasn't exactly it. That wasn't exactly the totality of monetary policy under the gold standard. Central banks still had some discretion over their collateral policies, like they do today. They could decide what kind of bills to discount, what kind of credit, how much credit to provide to the economy within limits, and they did so on the basis of the real bills doctrine. So the idea was that central banks would provide credit only in exchange for so-called real bills, only in exchange for credit generated in the course of actual business. So they wouldn't provide credit to financial markets. They wouldn't provide credit for speculation. They would only provide credit for business, for the legitimate needs of commerce. That's what the real bills doctrine told them they should do. Actual fact was that this arrangement didn't work all that well. You can immediately see how operating under the real bills doctrine would make monetary policy very pro-cyclical. You would be providing more credit to the economy when the economy is booming, when business is doing well, and less credit to the economy when it's doing poorly. So a prime example of this would be the Great Depression in the United States, when business did very poorly. We had a gigantic slump starting in 1929, and the Fed did nothing because it thought business is demanding less credit, so we should provide less credit. And that, in a nutshell, is why the gold standard collapsed globally in the 1930s. What did it give rise to? It gave rise to a long period of government control of monetary policy. So central banks, having not shown themselves to be reliable stewards of the economy in this earlier period, basically came, in many countries, including mine, under the direct control of government. That direct control in the US lasted until 1951, and it lasted in other places for even longer. There were limits on central bank independence. There were limits on competition in finance. There were limits on international capital flows. The commitment to stable exchange rates continued to limit the discretion of central banks and governments, but because of the presence of capital controls, they had more room for maneuver than before. Phase 3, I would call the rise of inflation targeting. So after the mid-1970s, you see more and more countries following this man, Alan Bullard, and his country, New Zealand, the first inflation targeter, to adopt this new regime. The problem in response to which they did so being that markets were gradually liberalized over time. Exchange rates become more difficult to peg as markets are decontrolled. That leads to the quest for alternatives, and the alternative, the new regime, has 4 features. Low and stable inflation as the central bank's key target or mandate. Each boat on its own bottom, which means each national inflation targeter worries about domestic inflation, and that's it. Central banks regain their independence. They're given greater independence, which enables monetary policymakers to pursue that mandate of low and stable inflation, and greater transparency of monetary policy making. Central bankers explain what they're doing. They release their minutes. They release votes. That is how they explain their actions, and that's the mechanism through which expectations are managed, and central banks are held accountable for their actions by the polity. They have to show that the actions they are taking are in fact consistent with their mandates. So that's the monetary nirvana at which we thought we had arrived 5 years ago, and now we realize it's not nirvana. I think inflation targeting, to be provocative, I write here, is dead, or at least it's gravely wounded. I think everyone now understands that central banks cannot simply focus on the inflation problem. They need to worry about the real economy. They need to worry about unemployment as well as inflation. And they need to worry about financial stability as well as price stability. Indeed, there is the possibility, which I think was quite real in the United States, that the more successful they are at stabilizing prices and output, the more risk they encourage financial operators to take on, and the greater the risks to financial stability they themselves create. So this is the story that the Great Moderation in the United States, the Fed succeeded in taming the business cycle and taming inflation. That led to the Great Moderation, and that encouraged leverage, risk-taking, and all the things that led up to the bubble and the crisis in 2007. There was the naive belief that central banks could simply focus on price, or perhaps price and output stability, and leave to someone else worrying about financial stability. That was the Greenspan doctrine. It didn't work. There was the belief that the central bank can worry about price stability. It doesn't have to lean against bubbles. And if necessary, it can clean up after the bubble bursts at tolerable cost. We found out that that is wrong as well. The costs can be very great. The regulators can be asleep at the wheel. Those two things both happened in the United States in the period leading up to 2007, and I think the belief now is that central banks have to worry about financial stability. They have to address bubbles and excesses in financial markets. They have to figure out how to lean against them before the fact, before they're allowed to get out of hand. And maybe they have to worry more about the cross-border spillovers of national monetary policies. So I think people would argue this in Brazil. I'm not sure Mr. Bernanke would acknowledge it. But the Fed has been quite active at extending swaps and credits to foreign central banks and providing dollar liquidity that other countries need. The each boat on its own bottom doctrine, I think, is slowly being modified. So we're moving toward a more complex monetary regime, an expanded mandate for central banks, where more regulatory authority goes back to the central bank. That's what happened in Britain. It was all taken away from the Bank of England as part of the bargain that made the BOE independent in 1998. It's now been given back to the bank. The Fed has gotten more regulatory authority post crisis. So central banks' mandates are becoming more expansive and more complex. That's a problem. It's more difficult for the public or the politicians to verify that when a central bank does something, that something is consistent with the central bank's mandate, because the central bank does one thing, it adjusts interest rates. Is it doing that in pursuit of price stability, output stability, financial stability? Harder to ascertain. Central banks, certainly my own, have increasingly been intruding into untraditional areas. They were the Fed was involved in the auto bailout in the United States. It has become involved in buying mortgage-backed securities and the mortgage restructuring issue. It's purchased corporate bonds. These are more politically sensitive actions than plain vanilla monetary policy, and that makes the central banks, all this makes the central bank's independence problematic. So I think it's no coincidence that the Fed's independence has come under threat, that not only Ron Paul in the US Congress, but a variety of other politicians in the United States question whether a central bank that engages in this wide range of different operations should be so independent from the politicians. I don't think that returning to the narrow mandate is an option. I think we've crossed the Rubicon. I think the financial crisis has taught us that simple recipes for central banking don't work. Central banking is complex business. I think history has also told us that central bank independence is valuable and important, but what that means is that central banks are going to have to fight very, very hard, much harder in the future than they have in the past, to defend and maintain their independence. And partly they can do that by being more transparent, explaining more fully exactly what they're doing, revealing more details from their balance sheets about exactly what they've done. So now we have the spectacle in the United States of Mr. Bernanke teaching university courses at George Washington University. I guess it's not a spectacle because he's an old university professor himself, teaching high school classes, giving speeches to all kinds of groups. That's the Fed's transparency offensive. They are trying to explain better, not only that they're nice guys, but explain more fully the rationale for the actions they've taken, how it's consistent with their mandate, precisely in the effort to defend their independence. People complain in the US that all these interventions that the Fed and other central banks have been engaging in are storing up problems for the future, and maybe they are. They may be storing up risks of inflation, a disorderly bond market correction. They've encouraged, the ECB through its LTRO has encouraged European banks to load up on risky sovereign debt. Stock markets in the US may have gotten ahead of themselves. We may have more bubbles. We have complaints about currency warfare problems. I think all those complaints have some validity, but the point is for the Fed and other central banks not to do what they've done would be creating even bigger problems for the present. I think the trade-off has been, do you address grave problems in the present, or do you create potential problems for the future that hopefully you can address and resolve at a later date? And that's what the Fed has chosen to do. So that brings me to the currency issue. What does this imply for the dollar? And in order to talk about what all of this implies for the dollar, I have to talk about the alternatives to the dollar, insofar as there are any such alternatives as well. And the starting point for my doing so is the observation that our monetary and financial world rests almost entirely on the dollar. That foreign exchange markets are essentially markets in dollars. 85% of all foreign exchange trades worldwide are trades of other currencies for dollars. The Bank for International Settlements, which surveys foreign exchange traders, tells us this is true. 60% of all known foreign exchange reserves worldwide are US dollar denominated securities. 50% of all international debt securities are dollar denominated securities. 2/3 of all foreign bank funding, when commercial banks borrow in order to undertake investments offshore in someone else's currency, 2/3 of the time they're borrowing in dollars. So this is really an anomalous situation. Once upon a time, it made a lot of sense. The US was half of the economy of the free world after World War II. It made perfect sense that everybody did their international transactions in dollars. Now that the US is 20% of the world economy, that it makes sense is much less obvious. So that's why people have been predicting the end of this dollar-based global monetary and financial world for a long time. They've been predicting it on the grounds that, as I just said, the US is much less dominant economically than it was 50 years ago, that once upon a time it made perfect sense to do your international transactions in dollars. That's less obviously true today when the US is only 20% of the world economy. Once upon a time, it made perfect sense to do your international transactions in dollars because only the US had a deep and liquid financial market open to the rest of the world. Europe had capital controls all the way up to the early 1990s. Virtually everybody did in one form or another. Indeed, some economies still have controls and taxes on capital inflows. But the point is that there are lots of other economies in year 2012 that have reasonably liquid financial markets open to international investors. The United States and the dollar no longer possess a monopoly in terms of liquid financial markets. There's the argument that the dollar will remain dominant because it has the advantage of incumbency. Everybody uses dollars now, and nobody has an incentive to switch away because the dollar is the international financial standard. It makes perfect sense for you to use dollars in your international transactions, given that everybody else is currently doing the same. I would observe that this is the same argument that people made in the past about operating systems for personal computers and the like. Everybody has to use Windows as their operating system because everybody else uses Windows. Interchangeability costs are high. Windows is the standard that is convenient. If you want to exchange data and information with your coworkers or clients, you have to use the same operating system they do. That may have been true in the past, but it's not true now. We've learned how to build, they have learned how to build open standards for consumer electronics, and I think we're doing the same in financial markets, where the costs of comparing prices in different currencies, exchanging your investment holdings between different currencies are much lower than they were in the past. This one, to my mind, is key. People predict that there will be movement away from this dollar-based, dollar-dominated global monetary and financial system because U.S. fiscal capacity is less than it was once upon a time. So this is the issue of global liquidity that I referred to before. The global financial system requires a safe asset, a safe and liquid asset that people can hold in risky times. And U.S. Treasury bonds have historically been that safe asset. Why is that? Because the U.S. Treasury bond market is the single largest financial market in the world. It has unparalleled liquidity. Standardized assets are traded there. Its liquidity is guaranteed. It's backstopped by the Fed. But the problem is that the global economy is growing more quickly than the United States. We are a mature economy. Emerging markets ought to grow faster than mature economies as convergence occurs over time. But what that means is that as the U.S. accounts for a shrinking share of the world economy, our ability to provide these safe assets, to provide global liquidity, will increasingly be outstripped by the scale of a more rapidly growing world economy. There will have to be other sources of global liquidity if the liquidity that 21st century globalization needs is going to be provided. So the International Monetary Fund in this issue from 3 months ago of its Global Stability Report flagged exactly this issue. And finally, because the U.S. economy is challenged, because we have some issues that we haven't been able to address. In the short run, we have a growth issue. I'm worried about the U.S. economy at the moment because I don't see where the growth is going to come from. Retail spending, the recent retail spending numbers were very bad. Consumer confidence or expectations are deteriorating. We're a consumption-driven economy. Consumption is 2/3, as you know, of the U.S. economy. The consumer is on hold. Inventories have been rebuilt. Export growth is slowing given that Europe is doing poorly and China is doing less well. The housing recovery may not be a recovery if you look at the latest existing home sales numbers. The Fed hasn't done much recently to support the economy. Households are still heavily indebted and trying to deleverage. So I've pretty much exhausted all the plausible sources of demand to support U.S. economic growth except one, and now I will go on and exhaust the last one being government spending. So what's happening at the moment is that the end of the 2009, 2010, 2011 Obama stimulus is occurring. Federal spending is returning to normal, And state and local spending is being cut violently because state and local revenues are doing very poorly. They depend on property taxes, which reflect housing prices, among other things. That's what's happening at the moment, and what will happen at the end of the year, as you know, is the fiscal cliff. So I don't know how many people are up on their U.S. fiscal cliff in this audience, but you will have noticed that two things are coinciding in the United States at the end of this year. One is we're having a presidential election, and the other one is that the Bush tax cuts finally expire. So if nothing is done before the election, which U.S. history suggests will be the case, and nothing is done by the lame duck Congress, the outgoing Congress that continues to sit between the election in November and January 20th, two things will happen on January 1st. Number one, the Bush tax cuts expire and taxes go up significantly. And number two, the process known as the sequester kicks in, where there occur automatic cuts in all non-entitlement spending by the U.S. government. So this will take something on the order of 3% of GDP out of the economy in 2013. Economists debate the size of the multiplier, but whatever you think the multiplier of fiscal policy is, negative fiscal impulse or shock of 3% of GDP is a big deal. So maybe the Congress and the next president will agree on doing the right thing. Mr. Obama would like to see the tax cuts, Bush tax cuts, retained except for the top 2% of the income distribution. And if that's done, that will mean a little bit more revenue, and the sequester can then be modified. The Republicans wouldn't like to see any of the above. So whether there can be a meeting of the minds, or whether it will look like the debt ceiling debate in August of 2011, stay tuned. But I'm deeply worried about how that will play out. All of that is about what will happen over the next year. People more regularly talk about the challenge that the U.S. Government faces over the medium term. We have structural budget deficits, and we have the possibility of explosive growth of our debt ratio. Every economist, every person in this room knows exactly what the U.S. has to do in order to solve that problem. Only three things. It needs to exercise expenditure restraint, where I think we've actually done pretty well. We need to raise more taxes. When I give this talk at home, I have to say, think about revenue enhancement. Instead, I have this graph here to tell my American audiences that the United States has some room to raise additional revenues. We are way down here as a relatively low tax economy. And we have to deal with the explosive growth of Medicare, Medicaid, and healthcare costs more generally. Very simple in principle, very difficult in practice, because there isn't a widespread agreement on my diagnosis, despite how obvious the facts really are. And there's, even among those who might share the diagnosis, there's no agreement on what to do, for example, in terms of building the healthcare and bending the healthcare cost curve. So there are, I think there are very serious reasons to worry about the United States and the dollar, both in the short term, given a weakening economy and a looming fiscal cliff, and in the medium term, given our lack of demonstrated political capacity to deal with our structural budget deficit problems. So the dollar remains the only true global currency. There are a variety of reasons why this is unlikely to continue, which I've now given you. There will have to be alternatives if the world is to enjoy an adequate global supply of global liquidity. the question is what alternatives? So that brings me to the even less happy case of the euro. So I sent a book off to the publisher about 2 years ago now, which was about the dollar, its exorbitant privilege as the world's only true global currency, and the alternatives. And I said one alternative going forward will be the euro. So I have a little bit of writer's remorse in that I was too optimistic about the euro, but who in their wildest dreams could have imagined the level of incompetence we've seen from European policymakers over the intervening 2 years? Not even me. And that has had an impact on the international use of the euro. The European Central Bank has been writing these reports for 10 years now, annually, about one of the great marks of the euro's success has been its growing international use. A new report came out a couple of weeks ago. The international use is not continuing to grow. People, central banks, private investors are moving away from the euro. It will not surprise you given recent events. So what is Europe to do? Everybody knows what Europe has to do, and increasingly we believe that it will not do it, which is kind of a dire prognosis. Europe needs to do only 3 things to solve its crisis: recapitalize its banks, because it has a banking crisis; get growth going again, because it has a very deep recession; and deal with its debt overhang, because in the current state of affairs, a number of European governments and a number of European sovereigns are insolvent. They're not going to be able to pay back what they've borrowed. So those are the 3 problems, and we know from the experience of other countries at different points in time. Brazil has had banking crises, growth crises, and debt crises, as have other countries. There's plenty of history to draw on to figure out how to address these issues. Let me skip forward a couple of slides. What we're seeing in Europe at the moment is big worries about the stability of European banks. So the figure I show you here is how the change in household and corporate deposits in the Greek banking system. And you can see all the bars are negative. Greeks have been withdrawing money from the Greek banks as fast as they can, and the only surprise is that as fast as they can hasn't been faster. There are some technical problems for the retail depositor, the small depositor, to get his money out of the country. The saddest story I heard was that because of language problems, a large number of working class Greeks were moving their deposits to Cyprus, which was not where you would want to deposit your money. But, you know, Greece sadly is what we say call in the US toast. The Greek story is over. Greece will exit the euro. Greece will default again on its debt. The Greek banking system is insolvent and will have to be fully recapitalized. Many people will not get their money back. All that is known, has been known for a while, but Greece is only 2% of Europe. Spain is more like 14% of the euro area, and the situation now seems to be exactly the same in Spain. So there was more disturbing information today about how the bank walk or bank jog is turning into a bank run in Spain, which might bring things to a head more quickly. So if you agree on this diagnosis, Europe has to complete 3 important tasks. Task number 1 is bank recapitalization. It has to restore confidence in the banks. I think bank recapitalization is probably the single most important thing Europe can do in the short run. It will be a visible signal. It can be done in a week with the proper political will. It will require much more than the 100 billion euros that was recently committed in principle, if not in practice, to recapitalizing the Spanish banks. And it will work only if these are loans by the European Stability Mechanism, the Rescue Fund, capital injections, equity injections directly into the banks, not loans to the Spanish government, which then are on lent to the banks, strengthening the banks while weakening the government. That's not going to solve the problem. We thought that Europeans had recognized this issue and had finally decided to address it on June 29th. They had another summit. It lasted till 4 in the morning. Again, they emerged from the summit and they announced that they were going to create a banking union that would basically have two elements: a common European supervisor and authorization for the European stability mechanism to inject funds directly into the banks. Hallelujah, everybody said. And they've been backtracking ever since. So this is Hans Werner Sinn, the German economist who has been leading the backtracking. The Germans are worried that you need protections that the European stability mechanism won't lose any money when it takes equity in the banks. You need a common supervisor to be sure that these problems will not be allowed to arise in the banking systems of small southern European countries again. And you can't have direct capital injections until that common supervisor is in place. The problem is, I think I had this on the earlier slide, there's supposed to be a proposal for a common supervisor by September. There's supposed to be agreement in principle on the common supervisor by December. You could imagine they might be able to staff it up under the best scenario next year. And the bank run seems to be occurring now. So there's what we call technically in economics a time consistency problem here. The Germans are definitely putting the cart before the horse. The markets are not waiting. So I don't know how that one is going to play out. I think opinion really has been polarized. In Germany, there's been a harsh negative reaction against banking union. In the rest of Europe, it's seen as increasingly important. Task number 2, getting growth going. Again, here I write all economists with a grain of common sense, which doesn't mean all economists agree on what should be done. Northern European countries whose governments can spend more should spend more to support demand. Southern European countries that have to consolidate should consolidate tomorrow rather than today. They should try to backload some of their fiscal consolidation. If they make really credible commitments to consolidate tomorrow, they can get away with spending more today. Meanwhile, the European Central Bank needs to do more to support growth. A weaker euro exchange rate, which the ECB could engineer, would be part of that story. And grants and aid rather than more debt, rather than piling more debt on existing debt, is the only way to keep Greece in the Eurozone. I conclude reluctantly that antagonism between the Greeks and the Germans has reached such heights now that all common sense on this issue is out the window. The Marshall Plan that Greece needs, and that I think it deserves, given that the Greeks didn't create their problems by themselves. The German banks, which lent them all that money, helped them. They're not going to get the Marshall Plan that would keep them in the euro. In the interest of time, I will go on and talk about task number 3, which is dealing with the unsustainable debts of not only Greece, but potentially Italy, Spain, Portugal, and Ireland. So what do you do about these countries whose interest rates are much higher than their growth rates, and whose debt to GDP ratios either are now or very soon will be above 100%? Everybody in this room who recalls their Brazilian history knows that if your debt to GDP ratio is above 100% and the interest rate you pay on the debt is above the growth rate, that's not a sustainable situation. That's the situation in which European countries find themselves. Here I think they have 3 options: what is called debt mutualization, make it the debt of the Eurozone or the European Union and not the debt of Italy. If they did that, Eurozone debt to GDP ratios would be lower than US debt to GDP ratios. But that's political poison in Germany. Option number 2 is to bring that nominal growth rate up relative to the interest rate. The ECB could intervene in the secondary market for bonds and push down the interest rate. It could bring inflation up a little bit if you believe that there's such a thing as a modest increase, central bank engineered increase in the inflation rate, and that would effectively inflate away a portion of the debt. But that's political poison in Germany. And option number 3 is to restructure these debts, which unfortunately is also political poison in Germany, because it has rather negative implications for the German solvency of the German banks, among others. So this is what we call in English a Hobson's choice, where none of the choices are appealing, none of the choices are possible. What do you do? My own assessment is that you need a comprehensive agreement by the politicians to do the debt mutualization, and that's impossible. You need a comprehensive agreement among the politicians to do the debt restructuring, and that's impossible. But you need a decision by a few central bankers to change ECB monetary policy. And while I'm not convinced that's likely, I think it is at least conceivable that such a thing might happen. So that leads to this conclusion that the only scenario under which the euro survives is where the ECB changes its stripes, where it engages in the European equivalent of quantitative easing, which enables it to buy bonds of sovereigns on the secondary market, where it can lend to the rescue fund, the ESM, which can turn around and recapitalize banks and buy bonds on the primary market. When Greece exits the Eurozone, the ECB can provide unlimited amounts of liquidity to the banks and the financial system. Foaming the runway is what you do when the plane is about to crash. Will any of this happen? There has to be German agreement to something in order for anything to occur in the euro area. And I can imagine a scenario in which the three important Southern European politicians form a united front. They talk sense to Mrs. Merkel, and she talks sense to the ECB. Am I saying this is likely? No, but it's a scenario. The problem, of course, being that the rhetoric within Europe has been becoming more antagonistic rather than less. It's hard to see how calm minds could prevail. We can come back to the Greek exit and the like. Let me skip over some of those things. There are a bunch of issues that I haven't talked about, like euro bonds and fiscal union and political union. I think we have learned that you can't have a monetary union without a banking union. You can't have a banking union without a fiscal union. You can't have a fiscal union without a political union. And I think European leaders always understood that, but they thought they had 30 years rather than 3 years to get there. In 2008, they were sideswiped by the global crisis, so they only have 3 years to get there. But I think the fiscal union and the political union have to be on the back burner. There are much more immediate problems for Europe to face. So that's a pretty dire prognosis for the euro. When I go to Europe, I like to tell them I'm the best American friend you have. I believe in the euro. I think holding the euro together will be immensely expensive, but breaking it up will be even more expensive. But you can tell from the last 20 minutes that I've grown much more pessimistic. So I can try to end on a slightly happier note by talking about the third candidate here, which is China, but I warn you, it won't be entirely happy. Chinese policymakers are intent on making their currency, the renminbi or the yuan, a true international currency, to encourage its use for international trade, international financial transactions, and 10 years from now or so to elevate it to the point where it is a consequential reserve currency as well. I think they understand that it's an advantage to the United States that U.S. banks and firms can do international business in dollars. It increases their competitiveness, it reduces their costs, it's convenient, and they would like Chinese firms to enjoy the same convenience. Chinese leaders think that Asia is moving toward a single currency as well, but they think it's going to be their currency, the renminbi. They have a typically well-formulated Chinese strategy for internationalizing their currency, one small step at a time. They're crossing the stream by feeling the pebbles under the water. They're progressively encouraging use of the renminbi in Chinese import and export transactions. They are allowing it increasingly now to be used in financial transactions. So the most recent announcement was they were creating a financial free trade zone in Shenzhen where there would be no capital controls. And if you were a Brazilian bank and you wanted to trade renminbi or invest in the mainland city of Shenzhen, you could do so without restrictions. There will be restrictions, and we'll see how porous they become between Shenzhen and the rest of the mainland, but it's another step in the direction of opening the Chinese capital account. They're going slowly but surely, but they're going in that direction, and the last stage will be to encourage use of the renminbi as a reserve currency. The Chilean Sovereign Wealth Fund holds Chinese government bonds. The Central Bank of Malaysia holds them as reserves, and I think the Central Bank of Nigeria, because of petroleum refining relations between the two countries, holds them as well. China has a long road ahead of it in order to accomplish this. Its financial markets are small, its financial markets lack liquidity, bank deposits are not an attractive form in which to hold central bank reserves, for example, because these are not normal commercial banks. They're still controlled by the government. Liberalization of the capital account may not continue if China experiences large outflows and a crash sometime in the future. There are doubts about the security of foreign investments. All reserve currencies in the past have been currencies issued by democracies in which foreigners feel secure about investing. Is that a problem for China as it seeks to internationalize its currency? I leave it as a question. And then there's the growth slowdown in China, which has two components. One is that China is aging. Its labor force has stopped growing. The share of the population that is elderly is rising. Its savings rate is poised to go down. Its growth rate will decelerate secularly over time. So the working paper I show you here, we wrote a couple of years ago. Boy, did we get criticism from the Chinese for saying your growth rate is poised to slow. Now that it's slowing, we get less criticism. And in the short run, I think there are questions about whether China, growth in China slowed to 7.6%, down from the double digits, recall, in 2012 quarter two. The housing market continues to weaken. New housing starts continue to fall. Export growth is lower because the global economy is doing poorly. And I worry that the official numbers, the light blue line at the top, which show a 7.6% growth rate in the most recent quarter, are questionable. Electricity consumption is falling in China. Are steel mills and aluminum smelting factories learning suddenly how to use less electricity? Or are the official growth numbers smoothed relative to the underlying reality? The fact that producer prices have been going down is another reason to worry that things are softening in China now more than the official numbers suggest. I'm less worried about China than some people and less worried about China than I am about the US and Europe, because China is a controlled economy. China is a planned economy, and the planners can tell the banks to lend, they can tell the state-owned enterprises to spend, and they can tell governments to invest in more infrastructure projects, and that's what they're doing. So the good news is that they can bring the Chinese economy in for a soft landing. The bad news is that the process of rebalancing, where bank lending is brought under control, there's rebalancing away from investment toward consumption, and dubious public infrastructure projects are no longer built. That rebalancing process is now going to be put on hold, and I think what that means is more problems will build up for the future. So where does that leave me? It leaves me relatively sanguine about the dollar. The US economy has big problems, but Europe's are much bigger. It's hard to bet on the euro in this environment, and the only perplexing observation is that the euro is still as strong against the dollar as it is. And I think if China continues to slow, one of the levers that Chinese policymakers will pull is to halt all appreciation of the renminbi against the dollar. They already have, because they want to keep exports going to keep the Chinese economy going. So to conclude, let me ask this final question. What does it imply for the world? What does it imply for Brazil if Europe fails to draw a line under its crisis? The euro does not become an attractive source of international liquidity. China is slow to internationalize the renminbi and encounters bumps on the road. The renminbi is not an attractive source of international liquidity. And worst of all, maybe there's a crisis of confidence in the US, and the dollar is no longer regarded as a safe haven and an attractive source of international liquidity. The answer is there is no adequate source of international liquidity. Switzerland cannot be an adequate source of international liquidity to the entire world. Australia cannot be an adequate source of safe assets to the entire world. They are
maybe Argentina, for instance.
Well, maybe Brazil at some point. So this is a world starved of liquidity. This is the world we saw in the 1930s, when trade credit for cross-border transactions becomes hard to obtain. Cross-border lending and borrowing become more costly and difficult to execute. Central banks do not have an attractive form in which to hold reserves, so they deal with financial volatility in other ways by tightening their capital controls. That's a scenario in which globalization as we know it is placed at risk, and that's what we saw in the 1930s when trade collapsed. This is the famous cobweb diagram from the League of Nations in the 1930s showing you the collapse of trade. International lending collapsed. The first era of globalization collapsed, and the Great Depression, a deflationary crisis, occurred because of a global shortage of liquidity, the worry being that it could happen again. Who could run to the rescue? I think the answer in the short run is no one. But if we manage to skate over the next 10 or 20 years, I do think Brazil could be a meaningful supplier of global liquidity along with the United States and Europe and China. And I think India, as a country with favorable demographics like Brazil, as a country with reasonably well-regulated banks and financial markets like Brazil, and with considerable scope for growing, already a large economy population-wise like Brazil, could be a meaningful, at least subsidiary source of global liquidity. So I think the story potentially is a very happy one. 10 or 20 years from now, I hope that everyone in this room lives so long.